right. Number 1. Okay. On January 1st, you opened your store and needed a petty cash fund, okay, for emergency expenses. All right. And you established a total, you established the petty cash fund to be a total of $500. That should be enough for the first month of operations. Okay. All right. So journalize this transaction. So how do I establish a petty cash fund?
Petty cash for 500
Petty cash for 500.
and checking.
Right. To establish for 500. Okay, good. So then number 2 says at the end of the month, okay, you counted a total receipts in the petty cash drawer, right? And of course, you had a total of $40.03 in the cash remaining. Replenish the petty cash fund. So here is the petty cash ledger that was recorded by the person who was in charge of the petty cash. So as you can see, on January 1st, we started out with $500. Okay, and then we could see that we have our employees take out some money to go ahead and buy minor expenses. So as you can see, here you go. Here's the track record of all the receipts that the employees have came back with and has given us. And they gave us a total here, right? A total cash left remaining is $40.03. So how do we go ahead and journalize all of this and be able to record all the expenses and replenish the petty cash fund?
Okay, will you put that as petty cash also?
You never, ever use the petty cash fund to replenish. How do you replenish a petty cash fund?
Okay, do you put it as a business expense?
Well, take a look at all of the items that you have here. Are they all business expenses?
No.
Okay. How do you replenish a petty cash fund?
Okay, I know you would use checking to um for the amount of the difference.
What do you mean for the amount of the difference?
Uh, for $459.
How did you get
96.
how did you get that number?
Um. Well, I see that the total left in the cash fund was $40.03. So we would add up the expenses to see if they'll what the difference is.
Good. So let's add up all of our receipts, right? Add up all
Right.
the expenses and see how much we actually get. So we get $459.97.
Right.
Okay?
And you would write a check for the 459.97.
Okay, good. So that I will record last because that is exactly what I need to do. Now, how do I record all of these expenses? Because these expenses occurred during the month of January.
Mm-hmm.
How do I record all of these? where do they go? How do I replenish a petty cash fund?
Mm.
Your thought process is correct. But how do I journalize this $459.97? We already know we're going to write a check to it, but where does that $459 come from?
Petty cash.
No.
Um,
Remember, we can never journalize the petty cash.
it came from your receipts.
It came from my receipt. So how do I address every single receipt?
Would you put it as receipts?
Well, do I have an account called receipts?
No. Accounts payable?
You don't owe the money. This is your money.
Mm.
Okay, so what was the rule? How do you replenish a petty cash fund? What does each receipt represent?
It represents cash that's being taken out.
Right, but I'm asking you individually, what does each receipt represent?
An expense.
Correct. So in this case, the first thing that Drew took out was office supplies expense.
Right.
So how do I record that?
So would it be expense?
Yes, you would record each and every single expense. So in this case, office supplies expense.
Right.
How much was this office supplies expense?
480.15.
480.15 was that expense? No.
I'm sorry, 1985.
$19.85. Okay. What's the next expense that happened?
Business expense.
We had a business expense. For how much?
54.17.
Okay. What's the next expense?
Meals, $35.22.
What did you say? Meals was for $35.22? Oh, yes. Okay. Right? What else?
Meals, 15.67.
So in this case, we have another meal. So in this case, I need to add my $35 plus my 15 because they're from the same exact account. Right? What's next?
Business expense.
Go back up one.
Oh, delivery.
You got delivery charges that you had to pay. Okay? How much was that?
$50.
It was $50. Okay? What's next?
Business expense, $22.78.
So you have another business expense. So that means I need to pick up this one and the previous one. Okay? What's next?
Office supply expense.
So you had another office supplies. Oh wait, nope. You skipped. Okay, so yeah, another office supplies expense for $6.99. You already have office supplies. Okay. What else? What else did you do?
Delivery expense for 100.
You got another delivery for 100. Okay. What's next?
Advertising
Y-
50.
Okay. What else?
Delivery expense for 25.
Okay.
Business expense for $30.33.
Business expense for $30 and 30 something cents. Okay. And then what else?
Withdrawal by the owner of $50.
You had an owner's withdrawal for $50. Okay. And then what is going to be for $459.97?
Checking.
Yes, you're going to write a check to the petty cash fund because you need to replenish it with cash. Okay? So this is how you properly record your replenish your petty cash fund. Is you need to recognize all the expenses that you occurred for January, and for the total amount of receipts, you're going to replenish the petty cash fund by writing a check. Yes.
Can I see the first graph that we did?
What do you mean graph?
I mean chart. It was the one that like we just yeah petty cash checking. Okay, cool.
Okay. So that's just so how we establish it. Okay? And then this is how we replenish it. We use the money, right? So in this case, we started off with $500, and then Drew took some money out, Susan took some money out, Mary took some money out, all the way down till the end of the month, where you're only left with $40.03, right? And then now, because we're so low in the petty cash fund, we need to replenish it. So normally, usually at the end of the month, or if you spent too much money already during the month, you want to replenish it as much as you can so you can have enough money to be able to, you know, pay for those minor expenses. So in this case, excuse me, I'm sorry. You're going to have all of these expenses here. You're going to record them one at a time, right, with the categories that they belong to, and you're going to put them all here and record them all here, and then you're going to write a check to all of the expenses. So all the receipts that you paid for, or all the receipts that you've already calculated and counted, you're going to tally them all up, and you're going to write a check for that exact amount. Okay, good. Question number 3. On June 1st, okay, your business begin to pick up, and the last few months you were running low on the cash. Okay, so in your petty cash fund. So now you decided to increase the amount by $300. Record this transaction. So how do I increase my petty cash fund?
Uh, are you gonna put established petty cash?
You're not establishing a petty cash fund right now. You already have one.
Okay. So you're gonna put increase petty cash.
That will be your description. How do you increase a petty cash fund? Right now, my petty cash fund is right now at $500. How do I make that into $800?
Credit it?
Not credit the petty cash fund.
Debit?
You're going to debit the petty cash fund. Good. And how do you get the money in there?
Checking?
You're going to write a check. Good. To increase okay? And you're going to increase it by $300. So now you have a total of $800 in your petty cash fund, right? Because I have $500 from the previous ones, and then now I just added $300. Okay. So number 4, at the end of the year, you decided to get rid of the petty cash drawer and use a business credit card, okay, for all of your minor expenses. Record the closing of the petty cash drawer. How do you close out a petty cash drawer? Right now you have money in it, right? So how do you close it out? Where's the money all go? If you try to close it out, where does it go?
It back to cash, back to checking.
It goes back into checking. Excellent. So in this case, right, it's gonna go back to checking
Mm-hmm.
for $800 because we increased it, right?
Right.
Now, what would be my opposite credit if I'm closing out the petty cash drawer? I no longer need it. You gonna credit your petty cash. Okay? So in this case, right, remember the rule of thumb here is you only use the petty cash account when you want to increase, decrease, close out, or establish. You never, ever, ever use it to replenish, okay, or to spend the money. In order for you to spend the money, you just simply spend the money, right? You have someone who records it for you that you're going to take money out, and they're going to, keep a track record for you. Whoever's the petty cash drawer manager, they're going to make sure that they write who took the money out and they bring back the receipt with the exact change, right? And then at the end, when you need to replenish because you're low on money, then you're going to count up all the receipts, right? You're going to acknowledge all the expenses, and you're going to write a check with the exact amount of money that you actually spent. Because right now I got $40.03 of cash in there, right? I need it to be back to $500. So I'm going to write the total number of receipts for me to replenish my petty cash fund. Okay? All right. All right, so now we're going to be moving on to chapter 10, right? So in this case, we're going to go through a series of questions and then we're going to answer them. So then for the next 5 questions, they're going to be related to each other. Okay, so one thing at a time, okay? So let's take a look at number 5 real quick, okay? Let me make this a little bigger, so. All right, number 5. All right, on June 15, customer A purchases a total of 100 toys for $5 each. And on an account, sales tax was 8.25%. Record this transaction. So June 15, customer A purchases a total of 100 toys for $5 each on an account. Sales tax is 8.25%. So how do I record this?
So it would be toys.
No. What is the transaction at hand right now?
The purchase.
No, yes. The customer purchased, right?
Right.
So what does that mean if the customer purchases?
Is it cash?
Well, let's read the scenario again. If on June 15, customer A purchases a total of 100 toys for $5 each on an account.
Okay, accounts payable.
No.
I mean,
Why is it not accounts payable? Do we owe the money or do the customer owe me money?
the customer owe you money.
Okay, so it's definitely not accounts payable. What would it be?
Accounts receivable.
It would be accounts receivable. Okay? Okay? Now, what did I do?
Okay.
If a customer purchase,
Okay, there was a sales tax applied.
there was sales tax. What else did we do?
Toys.
No. Has nothing to do with inventory.
Okay, it was on it was on account, so that's accounts receivable.
Yes.
And we got to pay sales tax at 8.25%
8.25% of what?
of the 500.
Well, where did the 500 come from?
It came from the toys times $5.
Okay, what account am I going to use to represent that? What did I do?
It's gonna be cash.
No, this isn't a cash sales. What is this? What is the transaction at hand? What did I do?
Purchase.
I did not purchase. Who purchased?
The customer.
So what does that become? If it
Sales receivable.
not a sales receivable, but just a sales, right? You sold something. All right, very basic information I'm trying to get to you guys right now is the customer purchased something from you. So what is that? You had a sale. You sold your product. And because you had sales, you are obligated to charge sales tax. So in this case, you have sales and sales tax. Okay? Okay, so in this case, we address that we purchased 100 toys at $5 each. So what's my total sales?
500.
Okay, $500. How much sales tax am I going to be charging?
$541.25.
Okay? So how much does customer A owe me?
$541.25.
Okay? So again, I'm going to go ahead and say customer A purchase 100 toys. Right?
Mm-hmm.
Okay, so let's see what happens next. Okay? Number 6. On July 15, we received a payment, right, check of $50 from customer A. Record this transaction. So number 6, we received money from the customer. So what happens when we receive money from the customer?
You're gonna debit your cash.
We received a check.
I mean, you're gonna debit.
You're going to debit checking on July 15. So we received money, right?
Right.
How much did we receive?
$50.
Okay, so then what's my credit going to be?
Accounts receivable.
Right, because they're paying for what they owe, right? So this is going to reduce my accounts receivable. By $50. So I'm going to go ahead and make a note here that received payment from customer A. Okay? Number 7. It's August 15. Customer A refuses to pay for the remaining amount that she owes. Record this transaction. So customer A is refusing to pay. So what do?
Would it be the allowance for bad debt?
Allowance for doubtful accounts is correct. Okay, so in this case, on August 15, allowance for doubtful accounts. Now, what are we doing here? We're moving it all to the allowance for doubtful accounts, right?
Right.
Okay. How much are we moving? And what are we moving into the allowance for doubtful accounts? What's my credit account going to be?
Okay, the allowance for double account that you be moving $450, right?
How did you get $450?
If we oh, wait a minute. Okay, is it 491.25?
$491.25. Okay, how did you get that number?
Okay, you would subtract it from the accounts receivable debt.
Okay, and so that means my credit account's going to be,
Uh,
you just said it.
491.
accounts receivable.
Yeah, but accounts receivable, right? Because
Right.
this customer says that they are refusing to pay, so that means you have potential bad debt, meaning you may not be able to collect this amount from customer A. Okay? So to remove customer A's accounts receivable balance. Okay? Number 8, okay? We contacted customer A to receive the debt that she owes, okay? To retrieve the debt that she owes. But then on October 20th, we end up receiving another payment of $15 from customer A. Record this transaction. So after months and months and months of trying, right, we finally got into contact with customer A, and we finally got $15 out of customer A. So what do we do?
Mm. Okay, would it be allowance for doubtful account?
Okay, what are you doing with the allowance for doubtful accounts?
You are decreasing it by $15.
You cannot ever decrease the allowance for doubtful accounts like that.
Okay. So it would you okay? We'll go back into accounts receivable.
Right now, customer A's balance is not in accounts receivable.
It's in the allowance for doubtful
It's
accounts.
in the allowance for doubtful accounts, correct?
Okay.
So it's like this, right? You get flagged that a customer is no longer going to pay. So what are you going to do? You're going to freeze their account, right?
Right.
Now that they're making another payment, what do you have to do?
Okay, you have to reverse it.
You have to reverse it. Good. Okay? So it's October 20th. So let's go ahead and reverse it.
So it'd be accounts receivable.
It would be accounts receivable. And
then would it be allowance for doubtful debt?
For how much?
I got $476.25.
Well, no.
No, it's for the $15.
No.
No.
491.25.
491.25. You have to reverse the transaction, right? Right now, they're outstanding at $491, right? We're going to retrieve the whole amount because on October 20th they paid me $15, that means I have a possibility they're going to make another payment in November and make another payment in December. Right? I have to be hopeful. So in this case, there you go. Now that I reverse the account, now it's unfrozen, right? It's active
Right.
now, right? So then now I need to record the payment. So I received another check for $15.
So it'd be checking
Checking.
for $15 and accounts receivable for $15.
Correct. Excellent. All right. Oh, hold on. I didn't put a note in here yet. Let me put a note in here. Okay, to reverse customer A's accounts receivable balance. Okay, and then here, received payment from customer A. Okay. All right, number 9. On November 28th, okay, a debt collector informs you that customer A has filed for bankruptcy and can no longer pay. Record this transaction.
Okay, it's going to be allowance for doubtful.
Mm-hmm. Okay?
And accounts receivable.
Good, because now we definitely know we're not going to ever get paid. So therefore, I need to freeze customer A's account. Now, how
And
much? Go ahead.
$476.25.
Okay. 476.25. Okay, good. So then last question of the day, or last question here is on yes.
Why do we have to make the allowance include sales tax?
Well, because we never collected the sales tax. So we have to take it out. Right? So we charge the customer sales tax, right? We never received a payment of the sales tax. Or all the money that you collected, maybe that paid towards the sales tax. So all this money that's left over is money that is owed. Now in this case, right, this is the grand total amount. We didn't separate the sales tax. It's included because we never received the sales tax. Or we never got paid the sales tax. So in this case, we would have to remove everything. So that's why it's including the sales tax as well. Okay. So then number 10, on December 31st, our company estimates that $2,556 out of our 200,000 accounts receivables are to be uncollectible. And there is currently a debit balance of $476.25 in the allowance or doubtful accounts. So let's go ahead and record this adjustment. Yes.
So did we get the merchandise back for the other one?
No, because we sold it to the customer, then they kept it. So here we have to take a loss.
Oh, they kept it, but they didn't pay?
Yes. So what do you do when customers don't pay? And this is exactly what we're doing here. We're writing them off as bad debt. Okay. So here, if on December 31st, our company has estimated that $2,556 is to be uncollectible, and there's currently $476.25 debit in the allowance for doubtful accounts. How do we record this adjustment?
Okay, would it be allowance for doubtful debts?
That wouldn't be the first thing.
Okay, it'd be accounts receivable?
No, because we are not increasing our accounts receivable. We're making an adjustment entry for what? If we say that there is accounts receivable that's to be uncollectible, what are we doing here?
Well, we're trying to write the whole thing off.
Right. What are we writing off?
The 2,500.
What is that 2,500? What is that considered?
Uncollectible?
Uncollectible what?
Bad debt?
Bad debt. So in this case, that's exactly what we're doing here. We are writing off our bad debt.
Okay.
Okay? Now, where does the bad debt expense come from?
200.
Accounts receivable?
Not the account receivable.
Allowance for doubtful.
It comes from the allowance or doubtful accounts because we've already written it off from the accounts receivable. So in this case, it's going to be allowance for doubtful accounts. Good. Now, question is, which method am I using?
Bad debt.
Okay, allowance method. Which allowance method are we using? There are two different types of methods to use for allowance method.
Income statement.
Not income statement.
Balance sheet.
Balance sheet. Now, why are we using the balance sheet? What keyword tells you that we're using the balance sheet?
Debit balance.
Debit balance, and what else?
And accounts receivable.
Accounts receivable is your key word to determine that you're using the balance sheet method. Okay? So in this case, does the debit balance in the allowance for doubtful accounts, does that affect your estimated amount?
Yes.
Yes. How? What's the rule?
Add if it's debit.
Add if it's debit. So in this case, how much am I going to be writing off bad debt for?
$3,032.25.
$3,032.25. Good. Right? So we're going to take my estimated amount of, what was it? 2,556. 2,556. And we're going to add the 471. The 471. 476.25. Good. All right. Any questions in regards to the allowance method? So this is what happens in real life, right? Where you have to deal with a customer and they fail to make a payment. What do? You need to freeze their account. And if you continue, sending them emails, giving them phone calls to try to collect the debt from them, right? And if you do end up collecting money from them, then you need to reverse the allowance. You need to unfreeze their account, because then now you need to be able to reduce the amount. But if they don't, and they end up saying that they end up filing bankruptcy or whatever information you do, and it's been like 6 months and they haven't made a payment, then that would be safe enough for you to be okay to assume that that this money's never going to be collected. Okay, so therefore it leaves a balance in the allowance for doubtful accounts. So then now that there is a balance in my allowance for doubtful accounts, I need to now write off my bad debt, because this is an estimated amount, right? I'm assuming that maybe customer A isn't the only one that's going to fault on their payment. My safest bet is to give myself a nice little threshold, which is 5%, usually up to 5% of your accounts receivable. So in this case, they said, okay, well, we're going to write off an extra $2,000 just in case customer A and a bunch of other customers decides to fault on their payment. Even though I didn't record that they did fault on their payment, right? Because it's an estimated amount. I don't know who, I don't know how much, and I don't know when, right? I'm just saying I'm going to write off this much bad debt, okay? But I know at least I've for surely written off customer A because I've already established it through the year, right? So that is the key thing that we're getting away here, is that this is how we do it. We record that we receive, that we have an account receivable. We record payments, and if they fault on their payment, then we put them immediately in the allowance for doubtful accounts. Okay? All right. So let's see what's next. Okay? So here we are. Okay? Let's practice those allowance methods here. Okay? So here, uh, number 11, yes.
So what exactly happens when the debt is written off?
You file for taxes and then you start the new year again.
Deduction?
Say that again.
So you get a tax break or tax deduction?
Yes. In this case, IRS allows you to take up to 5% of bad debt as a loss. No penalties.
Oh, okay.
Uh-huh. So then once you file for that, right? So you want to try to, I mean, you don't want to try to do so, but they're giving you up to 5%. So that means no penalties if you take a loss. Okay? Now that's only if you are allowing your customers to owe you on an account. Now, if you don't have an account receivable, then it won't. You don't get the same threshold, right? You don't get that same 5% like everybody else does. But that means, right? Realistically, right? Out of the hundreds and people that you serve to, right? And you allow them to owe you on an account, 5% might not be enough. Because realistically, right? On a realistic scale, can you expect that all 100% of your customers pay you?
No.
It's a responsibility to have to hold all of those accounts. So that's why oftentimes a lot of credit card companies, right, they love to have these kind of people because as soon as they fault their payments, that means higher interest, higher this, and then they're more likely to, penalize you for that. Right? So in this case, there's a lot of rules and a lot of regulations, especially when we're dealing with people who owe you on an account. Um, so so after you've completed your taxes, then you start the new year all over again, and you just continue recording your payments. Record if you have a new customer, have a new account. You just record, and then at the end of the year, if you have more bad debt to claim again, then you're going to go ahead and claim it. So at the end of the day, it's you managing, keeping track of your customers and making sure that they pay on time. Okay. So here, question 11. If on December 31st, your company estimates that $2,430 out of 500,000 total credit sales is to be uncollectible, okay? And there's currently a debit balance of $1,500 in the allowance or doubtful accounts. The adjustment entry will be
Will it be sales?
no. We
No.
are not dealing with sales. We are dealing with just bad debt right now.
So
Bad debt expense?
Bad debt expense. Okay. And where does the bad debt expense come from?
Allowance for doubtful debt?
Good. Okay. Now, in this case, which method are we going to be using?
Okay, the balance sheet?
Not the balance sheet. Why? Why not the balance sheet?
Okay, it's income.
It's income. Correct.
sales.
Where does the income come from?
The sales.
Right. I have total credit sales right now.
Okay, would you subtract?
Does the allowance for doubtful accounts affect your total credit sales?
Yes.
Let's review. What does the income statement look like? Does the income statement have anything to do with accounts receivables?
No, no, no.
No, because it's just your income, right? And all of your
Right.
expenses. So does the allowance for doubtful accounts affect your income?
No.
No. So what would your total amount be?
The 2430.
2430. Okay. Let's do another one. If on December 31st your company estimates that a total of $2,430 out of a 500,000 accounts receivable is to be uncollectible, and there's currently a debit balance of $1,500 in the allowance for doubtful accounts. The adjustment entry is
Bad debt expense.
bad debt expense. Okay, bad debt expense.
And allowance for doubtful.
Hold on, let me make sure I'm the right one. An allowance for doubtful accounts, okay.
Hmm.
Now, how much?
Okay, since this is accounts receivable, you'll be
Mm-hmm.
doing a balance sheet method.
Mm-hmm.
And so you would be taking the 1,500 out of the 2,430.
What tells you to take it away?
Um, Accounts receivable.
Oh, okay. Accounts receivable tells you which method you're using.
Hmm.
Credit balance.
Is there a credit balance? What does it say that you have?
No, it's a debit balance.
You have a debit balance. So what do?
You add.
You add. Excellent. So in this case,
$3,930.
3,930. Okay. Let's do another example. If on December 31st, okay, your company estimates that $2,430 of a 500,000 accounts receivable is to be uncollectible, and there currently is a credit balance of $1,500 in the allowance for doubtful accounts. The adjustment entry is
Bad debt expense
mm-hmm.
and allowance for doubtful.
Mm-hmm.
So, it's determined to be credit sales. So, would you take the 1,500
From
from the
where?
from the 2430?
Yes, but not total credit sales. We have a credit balance in the allowance for doubtful accounts. So in this
Right.
case, you're going to take 2430 and you're going to subtract 1500.
Right.
So what's that total going to be?
930.
$930. Okay. Last example here. If on December 31st, okay, your company estimates at $2,430 out of a 500,000 total credit sales is to be uncollectible, and there currently is a credit balance of $1,500 in the allowance for doubtful accounts. The adjustment entry should be
Add that expense
mm-hmm,
and allowance for doubtful
mm-hmm.
accounts. Okay. Okay, would you subtract the 1,500 from the 2430?
Which method are you doing right now?
The income statement.
So the income statement, does the allowance for doubtful accounts appear on the income statement?
No.
So does it affect the income statement?
No.
Okay.
So you'll be just using the 2430.
You would just be using the 2430. Good. Okay. So you guys need to pay attention to read to know what the difference is between the two, right? Even though I gave you 4 examples of using the same exact concept, only difference is what's different between them is reading carefully and identifying what the keywords are. So in this case, if you see total credit sales, you ignore everything and it's just whatever the estimated amount is. But once you see the word account receivable, you have to determine if it's a debit, you add. If it's a credit, you subtract. Right? All right. Question 15. Let's practice some simple interest here. Okay? So, what's my simple interest if I have a principal of $28,000 at a 4.35% with 150 days?
Oh, what's the formula? So that's principal times rate times the time.
Mm-hmm. Okay, so it's the principal times rate times time. So if you have a principal of 28,000 at a rate of 4.35% for 150 days. How do I calculate 150 days worth of interest?
Did we divide 150 days into months?
Correct. Okay, so in this case, 150 days. How many days are in 1 month?
30?
30 days are in 1 month. So therefore, how many months right here?
So it'd be 5 months?
It would be 5 months. Now, 5 months, right? How much is that equivalent to 1 year? Right? You have to have 5 months out of how many months are in 1 year?
12.
12 months.
So would it be 0.4166666?
For what? The interest? Or the month?
Yeah, for the time.
Okay, 416666666.
Okay. Okay, I got 500.
90.
What was that?
For the future value, I got $507.50.
What did you say, Norman?
6,090.
6,090. So you guys both got two different numbers. Okay? Am I solving for interest or am I solving for future value?
Future value.
What was your formula for future value?
Well, I used the 0.4166666, and then I kind of like reverse it. Then I multiply it. Hold on, I think what I did. I see what I did wrong.
Okay? So in this case, principal times rate times time is you're solving for interest, not future value. You're solving for how much interest you're going to be collecting in a span of 150 days, which is equivalent to 5 months. That is what you're solving for. Your future value is going to be your principal plus your interest. So in this case, what would my interest be?
It would be the 0.4166666.
That is just the months. Where's the rate? Where's the principal?
28,000 times 0.0435 times 5.
Not times 5. Because we have to use time in terms of years. So that's why I had you guys do what is 5 months out of 12 months.
$507.50.
$507.50.
Okay.
Okay? So then what's your future value going to be? I,
28,507.50 cents.
exactly, right? After your 5 months, how much is your principal going to be? That's the future value. And if you collected $507 of interest, you're going to add it to your principal and for your future value to be 28,507.50. Right? Good. All right. So let's do the next one. Right? If you had a principal of $5,147.50, your interest rate is 6%, and you have it for 10 years.
$308.85. Oh, 3,000.
What did you do?
I did 6% times 5,147, and then I times it by 10.
Okay, so you probably did a typo there. You probably missed a zero somewhere. Okay, so it's $3,088.50. So in this case, what's my future value going to be at the end of 10 years?
Oh, okay, let's see.
8,236.
Good. So last here, if we took a principal of $684,150, your interest rate is 3.49%, and you have it for 8 months.
$23,876.84.
I did not get that. What did you do?
I did 684,150 times 0.0349.
Okay, what about the time?
And then 8/12, 0.75.
Okay, so that should be. Try punching in your calculator again.
15,917.
There you go. Good. So your future value will be.
700,067.89.
Good. All right, Tommy, do you understand what's going on?
Yeah, I got, I finally got it because I was saying, well, how'd you get that 30 the 3.49%?
Okay.
But Okay, so I did do it as 3.49%, but then the other part of the equation is that we had to use the eight. We can put the 8 months, but we have to have it divided by 12 to get the interest.
Yes, because the time has to be in terms of years.
Mm-hmm.
Mm-hmm. And interest, because right now a percentage, you have to convert that to a decimals, which is zero. You have to move the point to the left too. So in this case, 3.49 is the same thing as 0.0349.
Well, they gave me the same thing when I hit the percent key. So
Oh, okay, good, good. If you have the percent key on your calculator, even better.
okay.
Okay. All right. So we do have one more problem, and all right. So this is where we last left off. Right. So now that we finish our interest, we're going to go ahead and dive into the last example here, which is going to be completing a bank reconciliation. Now, this is what your exam's going to most likely look like, and just because it's kind of difficult to attach so many documents on a Orbund. So in this case, this is going to be how the formatting is going to look. I'm going to provide you a table that has your bank statement, a table that has your check register and check ledger, whatever you want to call it, and then another table for your adjustments. So in this case, bank and cash, which side do you want to start on first?
Bank.
Let's start with the bank, okay? So I first need to figure out what my ending balance is in my bank statement. So let's take a look. Okay, so here's my bank statement. What's my ending balance?
$850.
$850. Okay? All right. Now, what's the rules? What do I need to add on the bank side?
All deposited checks.
All deposited in transit. Doesn't have to be checks necessarily, but it could be just deposits like cash. So let's take a look. So here on my cash register, I have how many deposits? How many deposits have I made?
4.
And how many has the bank cleared?
5.
Let's take a look at just deposits.
Oh, okay. 3 checks.
We're not looking at checks right now. We're looking at deposits, right?
Okay. We got 2 deposits.
We got 2 deposits, okay? Deposit number 44 and 45. So in this case, what other deposits have not cleared yet?
46 and 47.
46 and 47 for a total of 300 and 450. So in this case, I have deposit of 46. For 300. Wait, hold on. Yeah, 300 for 46 and 47.
And 47 is 450.
Okay?
So that's $750.
$750. Okay? Now, what do I need to subtract?
Outstanding checks.
Outstanding checks. That means checks that you have written that have not cleared yet. So in this case, how many checks have I written so far on my books?
4 No, hold on. 5 checks.
5 checks. And how many has the bank cleared?
3.
3. So which one is missing?
105.
105 is missing. What else is missing?
104.
104 is missing. Okay. So check number 104 and check number 105. Okay. So in this case, my check for 104 is for a total of $50. And my check for 105 is for $125. Okay. So in this case, what it would be my adjusted amount. Okay, if I started out with $850, I'm going to add $750 and I'm going to subtract $175.
Would it be 1425?
Okay, 1425. Okay. That doesn't mean we're done, right? Because we still have to check on our side to match. Okay. So, right here, ending balance. What's my ending balance in my cash ledger or check register?
1410.
You got 1410 right here. Okay. What do I need to add on my side?
All deposits.
Say that again?
All deposits.
No. What does the bank know that I don't know?
Checks that haven't cleared.
No, the bank doesn't know that.
Mm.
Right? Because I wrote the checks out, right? Does the bank know that?
No.
Okay, so that in this case, we're already done with the bank. Now, how do I adjust my side? What does the bank know that I don't know? What does the bank know that I don't know?
Interest.
Interest and
Fees.
fees is something that you're going to subtract, but in this case, interest and auto clearinghouse.
Right.
Okay, so let's check if we even have those. Okay, on our bank statement. Do we have interest and auto clearinghouse? Yes, we do. All right, for how much?
$200.
For $200 total, right? So I'm going to copy those down here. So we're going to add interest and ACH. Right? So let me see. Interest was $25 and my ACH was $175. Okay? And then what do I subtract? What does the bank know that I don't know?
Service fee.
Service fees. So let's take a look. Did we get charged? How many fees did we get charged?
$100.
For service fees. Okay, what else?
And I guess it's a return. the non-sufficient funds,
Non-sufficient. Mm-hmm.
and the RTN check fees,
Mm-hmm.
return check,
Yep.
$35.
Okay, so all right, so I gotta list those all out. We do service, then we got NSF fees, then we got return check fee. Okay, so a check, we entered in a check and it bounced. So let me see, we got $100 worth of services. We got NSF for 50, and we have return check for 35. Okay, so in this case, what is my total amount if I started out with $14.10? I'm gonna add $200 and I'm gonna subtract $185.
It came out to $14.25.
$14.25, and do they match at the end of the day?
Yes.
Yes, so that means we successfully did our bank reconciliation correctly, right? This is all I'm going to test you on. So that other example where we had mixed match monies and missing dollar bills and missing deposits, no, I'm not going to test you on that because this exam needs to be 4 hours long, okay? I'm not going to complicate you guys enough with that because you also have to deal with depreciation. So in this case, this is the simplest I'm going to do for you, okay? So remember, the bank side is your dues, your cash side is your ifs, right? Bank side dues is deposits and transits. So all your deposited money that you deposited, and then minus your outstanding checks. So checks that you've written that have not cleared yet, okay? And then for the cash side, right, we do our ifs, right? Or we have our ifs, right? Where we're dealing with our interest in ACH, and then we subtract out any fees because the bank already collected the money for me, and they also charge me those fees automatically. They take it out of your checking account without you knowing, right? It's automated, okay? So that is it for the chapter 9 and 10 exercise. Any questions? We will get to see another example tomorrow in the study guide.